hey,
magnificent,
hey,
magnificent,
hey,
magnificent,
hey,
magnificent,
hey,
magnificent,
hey,
magnificent,
hey.
Over the last 4 episodes, we learned how markets evolved. Now it's time to better understand today's market in the form of a usable mental model. Because the stock market isn't somewhere you go, it's something you connect to. And depending on who you are, you connect to it very differently. Most people experience the market through a retail brokerage app. You place an order, you see a fill, and it feels like you interacted directly with the market. But what actually happened is that you interacted with one access layer inside of a much larger system that is processing many different kinds of intent at the same time. Retail investors mostly need speed and simplicity for small orders, and that's what retail brokers are built for. Their job is access, compliance, aggregation, and routing. Execution itself is automated and usually handled by specialized firms downstream. Retail flow is predictable from the system's perspective. It's smaller, more urgent, more directional, and less sensitive to execution details like information leakage or market impact. Institutional investors operate on a completely different axis. A pension fund like CalPERS, an asset manager like Vanguard or BlackRock isn't trying to get filled. It's trying to move size without pushing the price against itself. Execution quality is measured over time, not speed. The goal is to blend into the market, not announce intent. And that's why institutions don't use retail brokers. They use institutional execution brokers and prime brokers. Execution brokers act as agents. They don't take the other side of trades. They work large orders, gradually slicing them across different exchanges, adapting to liquidity conditions, and minimizing information leakage. It's a process that keeps large institutional trades discreet. Prime brokers sit deep in the system. Their job is to make large-scale trading possible. Firms like Goldman Sachs, Morgan Stanley, JP Morgan, or UBS provide the infrastructure that allows funds to operate at scale. They handle clearing to make sure trades settle even if one party fails later, and custody to safeguard the assets themselves. They bundle those functions with financing, margin, securities lending for short selling, and risk aggregation. Then there's quantitative and systematic funds. Quant funds exist to exploit structure. They build models that identify relationships, inefficiencies, and constraints. Firms like Renaissance Technologies, Two Sigma, or AQR are often grouped together with market makers, but structurally they serve a very different role. Some trade slowly, rebalancing portfolios, and others trade quickly, arbitraging small discrepancies. The key point is that they are optional participants. They can step away when conditions don't suit their models. Market makers are different. Market makers exist to continuously quote prices and absorb order flow. Firms like Citadel Securities, Virtue Financial, and Jane Street sit at the center of modern markets and quote prices on many exchanges at once, take the other side of trades, and immediately hedge their exposure elsewhere in the system. Their goal is not to predict direction. It's to stay close to neutral while earning small spreads at enormous scale. Liquidity exists because market makers believe they can manage risk. They quote tightly when volatility is low, correlations are stable, and hedges work. They widen spreads or pull back when those assumptions break. That's why liquidity is conditional. It's not a permanent feature of the market. It's a behavior that appears when risk is manageable. This also explains why liquidity disappears unevenly. It doesn't disappear because people panic. It disappears because risk stops being hedgeable. That's how the system protects itself. Now let's layer in corporate issuers. Public companies themselves generate massive order flow through buyback, share issuance, employee compensation plans, and treasury activity. They matter because a buyback program introduces steady demand. Issuance introduces supply, and these flows can move prices without any change in sentiment or narrative. This is a crucial point for understanding why prices move. A large portion of market activity is not about believing a company is good or bad. It's about managing exposure. A fund might sell a stock because it needs to reduce risk elsewhere. Another might buy because it's hedging a short position. Someone else might be forced to trade because of a rebalance, a margin change, or a mandate. Then they translate those signals directly into trades. Share price is where all of those motivations collide. So let's break down the mental map. Every order from all these market participants enter the same system. Brokers provide access and responsibility. Routers create the illusion of a single market. Exchanges compete on speed, fees, and rules. Market makers supply conditional liquidity. Quant funds exploit structure when conditions allow. Corporations inject real supply and demand. Clearing restores trust, and rules bind everything together. Next time you trade, remember this. You participate inside of a system that's not built around you. Understanding that doesn't make you powerless. It makes you oriented. And once you see the market as a machine processing risk rather than a scorecard reacting to news, price movements stop feeling random. They start to look like the output of many constraints interacting at once. This is the modern exchange. and now you know how it actually works. Like, subscribe, follow at The Magnificent on Instagram and X, and let's keep the education going every Sunday at 11 a.m. Central.